I just closed my short position in CL, crude oil future contract, for over $33,000 in profit. But there's the interesting part. I'm still holding my short position in USO. So if they're both tied to oil, why should I close one and keep the other open? Well, it's pretty simple. Let me explain you why, and then we dive into the charts. And by the way, this is a follow-up video from my crude oil home run strategy video. And if you haven't seen that one yet, I'll link it up right here. It explains perfectly the original trade setup and why I entered the position in the first place. So, most people think oil is just oil, but that's not how it works. Crude oil futures track the price of oil almost in real time. So when the Iran war crisis, however you want to call it, pushed prices higher, the future reacted immediately. And when those tensions or fears faded away, future dropped as quick as it rose. So we are right now back at reasonable oil prices. But the USO is different. Instead of just tracking a single crude oil future contract, USO holds several future contracts. USO holds different future contracts with different expiration date. And because of that, it doesn't always move exactly the same like the frontman crude oil future would do. Sometimes, or many times, it lags behind, especially after very sharp moves caused by major news events, whatever. So, and there's something many investors don't know. Over the long run, USO tends to lose value because it has to continuously selling expiring future contracts and buying new ones every month. And in most market environments, those new contracts are more expensive, creating what's called a negative roll yield, which slowly eats the ETF's performance over the time. And that's why I decided to lock in my profits in the crude oil future contract, but I'm still holding my short position in USO because, in my opinion, the USO is still not there where it should be. It still hasn't fully reflected the drop we have already seen in crude oil. But right now, let's dive into the chart, guys, to explain it a little bit further. Let's go, guys.
Hey guys, welcome back to the chart right now. I just want to give you a brief update about my crude light oil future contract that I have since $101 over here. I could get a better entry, but $101 is pretty nice. We are 33,300 in profit right now, and we dropped aggressively until the pre-Iran war level at around about 65. We at 67-ish right now. And for me, that's more than enough. So I'm not going to leave the market because a future contract is expensive. And I expect before it could drop further low till 65, 60, or even more. But I expect a rebound before we're going to do it. But my main target was at 70 until 65. So the future contract I'm gonna leave right now just to let you know and keep you updated. The USO contract I still keep, let them run. So the USO ETF contract I will let it market. I have more downside there. Here's perfectly. I'm gonna leave the market over here just to let you know, keep you updated. So I'm gonna close it right now. Guys, have a good one. See you in the next video. Oh, guys, here we are in the chart of the USO, the United States Oil Fund. In the weekly chart, here it's better to explain why I still don't leave this contract, why I'm still gonna hold this short position. So it's be pretty simple because the market overshooted in the ETF a lot since the Iran war crisis, however you want to call it, began over here in February. It became 80 until over here on the highest top, $153 more or less. So it overshooted more than the crude oil future contract. So we have here the highest point back from 2022 at $90. And on average, since 2023, July 2023, till the Iran war backslash crisis started, we had our highest level at $83. So on average, the price the last 3 years was round about between 75 and 80-ish dollars. So it overshooted a lot, so it has a little bit more way to go down in relation to the future contract because it's not going to be that interesting anymore for people to buy the USA contract right now. So it's going to drop even more. That's why I show you in the weekly chart. So we have our next level at $90 more or less. This is my minimum target zone where I want to go with the USO ETF. And in a perfect world, it's going to drop until $83. Well, but I gotta decide at $90 what I'm gonna do. If it looks like it's gonna do a rebound before dropping even more, I do it the same way like I did it in the crude oil contract. Just leave manually, and if it looks like it's dipping even lower, I'm aiming to $83. So there's a lot more way to go on the downside here in the USO contract than in the crude oil future contract, in the CL contract. Just to explain it to you, let's go back to the video, guys.
Well, guys, here I am again for a few seconds just to end the video with a nice question. What do you think is going to happen in crude oil in the contract the next few weeks? Do you think that we're going to see a little rebound up to $18 or $85 again? Or do you think that the prices are dropping even further? Let me know in the comments, guys. If you like my content, please give me just a like. It would be really nice. It supports my video. And don't forget to follow. See you next video. Peace out. Sascha.